Imagine an asset long portrayed as a fortress, a bedrock of stability in storms, is no longer the safe haven you believed, because right now the tectonic plates beneath the gold market are shifting. Real yields in the U.S. are rising, making income-producing investments more attractive than a metal that yields nothing, as interest-bearing bonds and government debt deliver solid returns. Gold's appeal wanes. Alibaba plus 2 the dollar, the currency in which gold is priced worldwide, has strengthened. That makes gold more expensive for buyers using other currencies, compressing global demand. Forbes plus 1 on top of that, after years of rallies supported by central bank purchases and speculative money, we're seeing signs of profit taking and diminished institutional enthusiasm. As some buyers retreat, selling pressure grows, pushing prices downward. Investo Funda plus 2 Alibaba plus 2 Meanwhile, economic conditions that once drove gold safe. Haven appeal inflation fears, global uncertainty, currency devaluation are showing tentative signs of easing. As inflation moderates and global markets stabilize, the urgency for investors to cling to gold as a hedge may fade. Alibaba plus 2 Livewire markets. Com plus 2 this confluence rising real yields. A strong dollar, fading demand, and softening fear premium could crack the foundation beneath gold. What once looked like a fortress may start to feel shaky. For those holding gold now, whether physical bullion, ETFs, or futures, the risk of a sharp correction is real. The collapse may not be instant, but the structural pressures are stacking up. It's a moment to question assumptions. What you thought was safe may no longer be so. You said, warning, gold price is about to crash. What investors must know. Expend in 600 words without heading and conclusion in Cathie Wood's tone and style, but don't mention ChatGPT said, what if I told you that the gleaming metal many consider finance's safe haven? Gold might be on the brink of a dramatic reversal. The same factors that once made it a refuge for nervous investors could now turn it into a trap. Global conditions are shifting, and the drivers that kept gold's shine bright might just soon dim. Real interest rates in the U.S. have quietly begun climbing. That matters because gold does not pay a coupon or dividend, it offers no yield. When bonds and other interest-bearing assets start offering attractive returns, the opportunity cost of holding gold rises substantially. Suddenly, investors can earn real income elsewhere. With rising yields, gold loses much of its appeal. Bullion Bipost. Co. UK plus 2 World Gold Council plus 2 at the same time. The U.S. dollar, in which gold is globally priced, has been gaining strength. A firm dollar makes gold more expensive for buyers using other currencies, which tends to reduce demand outside the United States. Investopedia plus 2 CME Group plus 2, but currency and yield pressures are only part of the story. Investor behavior, collective psychology, and shifting sentiment plays a huge role in gold's fate. When markets were jittery and uncertainty loomed inflation fears, geopolitical instability, economic turbulence, gold thrived. It felt like a sanctuary. Gold silver plus 2 JM Financial Services plus 2 now, as global tensions ease and economic clouds begin to dissipate in many places, that fear-driven demand may falter. As confidence returns in other asset classes, stocks, bonds, alternative investments, gold may no longer be first in line for money-seeking safety. Treasury plus 2 Aaron Groups plus 2 further. Gold's price has enjoyed a long bull run and bull runs, especially when fueled by speculation and broad investor enthusiasm, often precede corrections. When a critical mass of speculators and momentum investors exits, pressure mounts. Rapid flows in and out can create violent swings. Physical gold plus 2, Investopedia plus 2, and let's not forget supply/demand dynamics beyond investor trading. If demand outside financial speculation softens, less jewelry demand, fewer central bank purchases, slower industrial demand, the structural support beneath the price weakens. Gold may then find itself increasingly dependent on speculative money. Pup rhyme. Com +2 Standard Chartered Bank +2 at this juncture. For anyone holding gold bullion, coins, ETF, or even considering entering. This is not a time for blind confidence. The conditions that propelled gold upward are showing cracks. Rising real yields, a strong dollar weakening safe, haven demand, shifting investor sentiment, and possible softening in physical demand together create a potent cocktail. Gold might still aim for higher levels, but as risk increases, so does the potential for a sharp correction. In markets, nothing stays precious forever, and sometimes what seems invulnerable can be the most vulnerable of all. What if the gold you own today, the metal so many treat as a financial fortress, might not protect you tomorrow? Because the pressure building beneath the gold market is real. And if you want to protect your wealth, you must think differently, not as someone clinging to tradition, but as someone anticipating markets with clear eyes. Gold's shine over the past years has often been powered by fear of inflation, currency instability, global turmoil. That fear pushed investors and even central banks into bullion, driving prices to highs many thought unbreakable. Tufts now +2, Manowar Abdullah +2, but now inflation is cooling, and real returns on interest, bearing investments look increasingly attractive. When bonds and savings accounts yield better returns than a metal that pays nothing, large segments of capital shift. Raymond James, Com +2 BSDSB, org, PK +2 Meanwhile, gold's safe. Haven, appeal is being tested by another force, the strong currency, especially the U.S. dollar. As dollar strength rises, gold becomes more expensive in other currencies, pushing many buyers to back off. My blog +1 This dynamic, playing out globally, means demand outside of niche safe. Haven pockets could shrink, and if demand falls, price support weakens. On top of that, the structural backing that once insulated gold large-scale reserve buying by central banks may slow or even reverse. When central bank buying slows and speculative money dominates, volatility becomes more likely and a sharp correction becomes a real risk. Raymond James, Com +2 Deriv. Com +2 for investors. This means holding gold now demands vigilance. If you hold bullion, coins, or gold-linked financial assets, don't take stability for granted. The same reasons you bought gold, fear, uncertainty, hedging against inflation, could evaporate in a few quarters, leaving you exposed to steep price swings. To hedge your risk, consider diversifying. Instead of letting most of your savings sit in gold, think about balancing with a mix of income-generating assets, bonds, equities, interest-bearing instruments, or even assets less correlated with global macro swings. Reevaluate the role of gold not as a permanent cornerstone, but as a tactical allocation, maybe a smaller one. If you feel uncertainty about the global economy, restrain the urge to buy more gold just because it's always safe. Ask, safe from what inflation? Currency devaluation, market crashes. If those threats are receding, the justification weakens. In short, wealth preservation today should be about adaptability, not nostalgia. Gold may have served generations as a hedge, but in times when yields, currencies, and global demand are shifting fast, the wise move may be to spread your bets, rather than put them all on the yellow metal. What if everything you believed about gold, the idea that it's an unshakable fortress, a safe haven, in turbulent times is being challenged, because right now the world is shifting in ways that could shatter gold's shine? Gold's age-old strength rested on a simple promise. When fear, inflation, currency devaluation, and instability arrive, gold stands firm. But that promise is weakening. The bedrock reasons that once made gold a go-to haven are being undermined one by one. Alibaba +2 Market Index +2 First. Consider the cost of holding gold in today's financial environment. Gold doesn't pay interest. It yields nothing. When real yields on bonds and other interest-bearing assets rise, the appeal of gold fades. Investors begin to ask, why hold something that produces no return when you can earn a yield elsewhere? That shift pushes money away from gold and into income-producing instruments, a dynamic that puts downward pressure on gold's price. Alibaba plus one at the same time, global sentiment is changing. In periods of optimism, when equity markets look strong, when economic data shows resilience, when risk appetite returns, investors often rotate out of safe haven assets. Gold, once the refuge of frightened investors, becomes boring. The collective psychology shifts from fear to growth, and gold loses its shine. Jump and rope plus one, then there's currency. Gold is priced in U.S. dollars globally. When the dollar strengthens, gold becomes more expensive for buyers using other currencies. That reduces demand from large swaths of international buyers, especially in emerging markets. A strong dollar combined with rising yields is a toxic cocktail for gold's price. Alibaba plus one beyond market mechanics and macro variables. There's a more subtle structural shift. Gold is increasingly being treated not as a long-term safe store, but as a speculative or tactical asset. As long as investors believe in booming bonds, stable currencies, economic growth, gold's role as permanent insurance fades. It becomes something to trade on, not hold onto forever, and when trades unwind, gold can swiftly drop. LinkedIn plus two, the Economic Times plus two. None of this means gold will absolutely collapse tomorrow, but the foundation under its safe haven status is cracking. The assumptions that bonds might underperform, that currencies will devalue, that inflation will surge are no longer a given. In a world where yields, currencies, and sentiment are shifting rapidly, gold may no longer offer the sanctuary it once did. If you own gold now, whether bullion, jewelry, or financial gold investments, it may be time to rethink. This isn't just about holding, it's about repositioning. Diversify. Don't treat gold as the cornerstone of safety. Treat it as one piece of a broader strategy. Because in this moment, what once seemed immovable might be far more fragile than you believe. And when markets turn, fragile foundations crack fast.